4 weeks. 4 straight weeks of losses. And if you have money sitting in the stock market right now, what I'm about to tell you in the next 15 minutes could be the most important thing you hear all year. Because this is not a dip. This is not a correction. Something much bigger is happening underneath the surface. And the people on Wall Street already know it. They just aren't telling you. Let me start with the raw numbers, because numbers don't lie. The S&P 500 just closed its 4th straight losing week, the longest losing streak in an entire year. The Dow Jones Industrial Average dropped 443 points in a single day on Friday alone. The Nasdaq tumbled 2% in one session. And here's the number that should freeze you in your tracks. The S&P 500 is now sitting more than 6% below its all-time high of 6,797, which it hit back in January 2026. 6% gone in weeks. And the people who were supposed to protect your money, they were wrong about everything. Because just 3 months ago, analysts were celebrating. Wall Street was throwing around numbers like 7,600 for the S&P 500 by end of year. Goldman Sachs had a target. JP Morgan had a target. Everyone had a target. And every single one of those targets is now bleeding out on the floor. Because nobody, and I mean nobody, predicted what happened next. Oil went from $67 a barrel to over $112 a barrel in the span of days. Let that sink in. That is a 66% spike in oil prices in almost no time at all. The fastest oil price surge in more than 40 years, and every single dollar of that increase is coming straight out of your wallet. Think about what that actually means for your daily life right now. Gas prices have already jumped 50 cents per gallon across the country. And that's just the beginning, because when oil goes up, everything goes up. Groceries go up, shipping goes up, manufacturing costs go up, airlines raise ticket prices, delivery companies raise fees, and every single business that uses energy, which is every business, passes those costs directly to you, the consumer. You are the last line in the chain. And right now the chain is on fire. But here's what makes this moment truly dangerous. It's not just oil. It's not just one thing going wrong. It's everything going wrong at the exact same time. And when multiple crises stack on top of each other, markets don't just dip, they collapse. So let me walk you through every single layer of this crisis, because you need to understand the full picture before you make any decisions about your money. The first layer is oil and the geopolitical shock that caused it. The Strait of Hormuz, a narrow waterway that handles roughly 20% of all global petroleum exports, was disrupted. 20% of the world's oil supply gone from the market in a matter of days. That's not a statistic you just read and move on from. That is a fundamental shock to the global energy system. Brent crude, the international benchmark, rose to $112 per barrel by the end of last week. U.S. crude hit $98. And some analysts are now warning that if this situation doesn't resolve quickly, we could be looking at $150 oil. $150. And if that happens, every forecast, every projection, every model that Wall Street is currently using becomes worthless overnight. The second layer is inflation, and this one is the quiet killer that most people aren't talking about. Because even before oil started spiking, inflation was already refusing to die. The Producer Price Index, which measures what businesses pay before those costs get passed to consumers, came in hot not once, but 2 months in a row. 2 consecutive months of sticky, stubborn, refusing to go away inflation. And that matters enormously because it tells you that the pressure building inside the economy was already there before any of this started. Oil just poured gasoline on a fire that was already burning. Nathan Peterson, a market analyst, put it plainly. This isn't just about Iran and higher oil prices. It's about sticky inflation and what it means for Fed policy. And when it comes to the Fed, the situation has completely flipped. The third layer, and this is the one that is truly shaking markets to their core, is the Federal Reserve and interest rates. Just weeks ago, traders were confidently betting that the Fed would cut interest rates at least twice in 2026. That was the consensus. That was what the market had priced in. Lower rates mean cheaper borrowing. Cheaper borrowing means more spending. More spending means higher corporate earnings. Higher corporate earnings mean higher stock prices. That was the entire bull case for 2026, and it just got completely destroyed. According to data from CME Group, traders have now canceled nearly all their bets on a rate cut this year. All of them. Gone. And it gets worse. Some traders are now actually beginning to bet that the Fed might raise rates in 2026. Raise them. In an economy where consumers are already being crushed by high prices and a crashing stock market. Ann Maletti, head of equity investments at Allspring Global Investments, called it what it is, market shaking. That is a direct quote from someone who manages billions of dollars. She said it would be market shaking, and she's right. The fourth layer is valuation, and this is where the story gets truly scary for long-term investors. The CAPE ratio, which is the Shiller price-to-earnings ratio that measures how expensive the stock market is relative to earnings over the past 10 years, currently sits at 39.8. Let me put that in perspective for you. The long-term average CAPE ratio is around 17. Right now it's at 39.8, more than double the historical average. The only other times in the past 150 years that the CAPE ratio has been near this level were in the late 1920s, right before the Great Depression, and in the year 2000, right before the dot-com bubble burst. Both of those periods ended with catastrophic market crashes that wiped out fortunes. Retirement accounts destroyed, savings gone, decades of wealth erased in months. And right now, the CAPE ratio is telling us we are closer to those moments than at any point in a generation. The fifth layer is something called the Buffett indicator, named after Warren Buffett himself, who once called it the best single measure of where valuations stand at any given moment. The Buffett indicator measures total stock market capitalization as a percentage of GDP. When it's at 100%, the market is roughly fairly valued. When it pushes above 150%, it historically signals danger. Right now, the Buffett indicator is sitting between 217% and 228% of GDP. 217%. That is far beyond anything we saw during the dot-com bubble, which peaked at around 150%. We are in territory that has no modern precedent, and the market is still, right now, sitting at elevated levels even after 4 weeks of losses, which means the fall, if it comes, has much further to go. The sixth layer is market concentration, a risk that is invisible to most everyday investors until it's too late. The top 10 stocks in the S&P 500 now represent over 35% of the entire index's weight. That means when you buy an S&P 500 index fund, something millions of Americans hold in their 401k and retirement accounts, you're actually making a massive concentrated bet on just 10 companies. If those 10 companies run into trouble, the entire index gets dragged down. And we already saw what that looks like. Back in early February, markets experienced what analysts are calling a system-wide breakdown. Stocks, bonds, gold, silver, even Bitcoin all crashed together in the same week. That almost never happens. When everything falls together, it means the system itself is under stress. It means the normal relationships between assets that investors rely on for protection are breaking down. And now, here's the seventh layer, the one that almost nobody is talking about, the midterm elections. The S&P 500 has historically suffered a median peak-to-trough decline of 19% during midterm election years. That's not a guess. That's not a prediction. That's what has happened historically, over and over again, regardless of who is in power. Policy uncertainty makes investors nervous. When investors get nervous, they sell. When they sell, prices fall. And with the current political environment being as polarizing as anything we have seen in decades, Morgan Stanley has already flagged it directly. Affordability is the key issue going into the midterms, and supply chain pressures combined with energy prices are top of mind. In other words, the political calendar itself is working against the market right now. History says there is a 50-50 chance the S&P 500 drops at least 19% at some point this year. From the January high of 6,797, a 19% drop would put the index at around 5,506. That's roughly 15% below where it closed last week. 15% more downside. And that's just the historical median, not the worst case, the median. Now, here is where most finance channels stop. They show you the scary numbers, they make you feel like the world is ending, and then they leave you sitting there with no idea what to do. That's not what we do here. So let me tell you what smart money is actually doing right now, and what you should be thinking about for your own portfolio. The S&P 500 crossed below its 200-day moving average on March 19th. That is called a bearish breakdown. It sounds technical, but here's what it means in plain language. The momentum of the market has fundamentally shifted from up to down. In the last decade, every time this has happened, the average peak-to-trough decline was 17%. But here's the other side of that number that you need to hear. Following those 28 bearish breakdowns in the last decade, the S&P 500 went on to gain an average of 16% over the next 12 months. The market fell, sometimes hard, and then it came back, every single time. Because that is what markets do. They go down, and then they come back up. The investors who panic, who sell at the bottom, who let fear make their decisions, those are the people who lock in permanent losses. The investors who understand what is happening, who stay calm, who prepare, those are the people who end up on the right side of history. So what does preparing actually look like right now? First, do not sell everything in a panic. Panic selling is how average investors destroy decades of wealth in a single afternoon. The best single-day gains in market history have happened within weeks of the worst single-day losses. If you sell during the crash, you miss the recovery. And missing the recovery is worse than experiencing the crash. Second, if you have cash on the sidelines, this is when you start paying close attention. The analysts at Motley Fool who study this full-time are saying it plainly. This is a buying opportunity. Not to go all in right now, but to start preparing. Deploy some cash now if you have conviction. Hold some back in case the market falls further. Dollar cost average into quality positions, rather than trying to time the exact bottom. Because nobody, not Warren Buffett, not Goldman Sachs, not anyone, can time the exact bottom. Third, look at your portfolio and honestly assess how much risk you're carrying. If the idea of the market dropping another 15% from here would cause you to lose sleep, that is important information. It means your current allocation is too aggressive for your risk tolerance. And the time to address that is now, not after another 15% drop. Here's the bigger picture that you need to carry with you. 72% of Americans right now have a negative view of the economy. That is according to a Pew Research survey from February 2026. Nearly 40% believe economic conditions will be worse a year from now. That level of pessimism is actually historically significant, because extreme pessimism tends to mark bottoms, not tops. When everyone is scared, when everyone is selling, when headlines are screaming disaster, that is historically when the best buying opportunities emerge. Not because the problems aren't real. They are real. Oil is at $112. Inflation is sticky. The Fed is on hold. Valuations are stretched. All of that is true. But markets price in fear quickly. And once the fear is fully priced in, the only direction left is up. The GDP is still projected to grow at 2.5% for 2026, according to a Bloomberg survey of analysts. The Atlanta Fed is tracking first quarter GDP at 2.3%. The economy is slowing, but it is not collapsing. Earnings are still coming in. Companies are still operating. And history, all 150 years of S&P 500 history, shows that the index has always recovered from every single correction, every single bear market, every single crisis that has ever hit it. Everyone, without exception. The question is never whether the market will recover. The question is whether you will still be in it when it does. This week is going to matter. We have final fourth quarter GDP numbers dropping on March 27th. We have the University of Michigan consumer sentiment data coming. We have earnings from companies like GameStop and KB Home. Every single one of those data points is going to move this market. And we are going to be here covering every development as it happens. Because right now, staying informed is not optional. Right now, staying informed is the single most important thing you can do for your financial future. If this breakdown gave you clarity on what is happening and why, hit subscribe. Because this is just the beginning of what could be the most consequential financial year of the decade. And you need to be ready.